The Canadian housing market has been a pretty hot topic for the last few years. It's been on a steady rise with prices soaring to record-breaking heights. However, a lot of recent data from 2023 suggests that this trend might not continue for much longer. In fact, experts predict that the Canadian housing market is more likely to crash than the US housing market. This prediction is based on a number of factors, including high household debt, an oversupply of condos, and a potential for more increases in interest rates. While the US housing market has also experienced its fair share of ups and downs, it appears to be in a much more stable position than its Canadian counterpart. So in this video, we're going to be taking a closer look at the data and factors that suggest the Canadian housing market might be headed for a crash, and what this could mean for homeowners, investors, and the economy as a whole. The first thing we're going to be discussing is understanding the Canadian housing market. The Canadian housing market has been on the steady rise since the financial crisis of 2008. However, this rise has been accompanied by a surge in household debt. In fact, according to Statistics Canada, the household debt-to-income ratio in Canada has reached a record high of 178.5% in the first quarter of 2023. This means that for every dollar of disposable income, Canadian households owe $1.79 in debt. This high level of debt is a major factor contributing to the potential crash of the Canadian housing market. Another issue facing the Canadian housing market is the oversupply of condos. A lot of developers have focused on building condos in urban areas, leading to an oversupply of these types of properties. This has ultimately resulted in a slowdown in the condo market, with prices starting to decline. Additionally, a lot of investors who purchase condos as rental properties are now facing lower rental income due to oversupply, which has made it harder for them to cover their costs. Next, let's understand the US housing market. Now, the US housing market has also experienced its fair share of ups and downs. The 2008 financial crisis hit the US housing market pretty hard, leading to a significant decline in home prices. However, since then, the US housing market has made a pretty strong recovery. And according to the National Association of Realtors, the median existing home price in the US was $310,800 in the first quarter of 2023, which is up 16.2% from the first quarter of 2022. And one of the factors that has contributed to the stability of the US housing market is the stricter lending standards that were in place after the 2008 financial crisis. These standards require borrowers to have higher credit scores and more income documentation, which has helped to prevent risky lending practices that contributed to the previous housing market crash. Next, we're going to be comparing the data between the Canadian and US housing markets. When we compare the data between the Canadian and US housing markets, it's pretty clear that the Canadian housing market is in a more compromising position. According to the Mortgage and Housing Corporation, the average price of a Canadian home was $716,828 in 2023, which is up 5.2% from the previous year. In contrast, the National Association of Realtors reports that the median existing home price in the US was again $310,800 in the first quarter of 2023, which is again up 16.2% from the previous year. Another key difference between the two markets is the level of household debt. As previously mentioned, the household debt-to-income ratio in Canada reached a record high of 178.5% in the first quarter of 2023. Contrast that, the household debt-to-income ratio in the US was 92.6% in the fourth quarter of 2022, according to the Federal Reserve Bank of New York. This suggests that US households are in a more stable position than their Canadian counterparts. Next, let's talk about factors contributing to the Canadian housing market crash. There's several factors that are contributing to the potential crash of the Canadian housing market, but one of the key factors is the high level of household debt. And as previously mentioned, the household debt-to-income ratio in Canada is at a record high, which means that Canadian households are more vulnerable to economic shocks. So if interest rates were to rise significantly, a lot of households could find themselves unable to make their mortgage payments, which could lead to a surge in foreclosures and a decline in home values. Another factor contributing to the potential crash of the Canadian housing market is the oversupply of condos. And as previously mentioned, a lot of developers have focused on building condos in urban areas, leading to an oversupply of these types of properties. This oversupply has resulted in a slowdown in the condo market, with prices starting to decline. Additionally, a lot of investors who purchase condos as rental properties are now facing lower rental income due to oversupply, which has started to make it harder for them to cover their costs. Next, let's talk about government policies and regulations that affect the housing market. Government policies and regulations can have a significant impact on the housing market. In Canada, the federal government has implemented several policies aimed at cooling the housing market. For example, in 2021, the federal government implemented a stress test for uninsured mortgages, which requires borrowers to prove that they can make their mortgage payments at a higher interest rate than the one that they're applying for. Additionally, the federal government has implemented a foreign buyers tax in some markets, which has helped to cool demand from foreign buyers, but hasn't stopped it. In the US, the federal government has also implemented policies at preventing another housing market crash. For example, the Dodd-Frank Wall Street reform and the Consumer Protection Act, which was enacted in 2010, established a number of rules aimed at preventing risky lending practices. Additionally, the Federal Reserve has kept interest rates relatively low in order to help stimulate the market and to prevent maybe another recession. So next, let's talk about economic outlook and its impact on the housing market. The economic outlook can have a significant impact on the housing market. In Canada, the economic outlook is somewhat uncertain. While the economy has been growing steadily, there's some serious concerns about rising inflation and the potential of more interest rate hikes. Additionally, Canada's reliance on the housing market as a driver of economic growth is a pretty big concern. Because if the housing market were to crash, it could have a significant impact on the wider economy. In the US, however, the economic outlook is somewhat more positive. The US economy has been growing at a steady pace and unemployment is at historic lows. Additionally, the Federal Reserve has signaled that it's going to try to keep interest rates low for the foreseeable future, which should help support the housing market. Next, let's analyze the impact of COVID-19 and the Canadian housing market. The COVID-19 pandemic has had a significant impact on the Canadian housing market. Initially, there was a slowdown in the market as buyers and sellers stayed home due to lockdowns and restrictions. This was also a time that I found it to be a very big opportunity when there was a lot of fear and confusion in the market, and I ended up purchasing probably the most amount of real estate I have ever purchased within a given period of time, of being around the first 6 months of the COVID-19 lockdowns. However, as the pandemic continued, demand for housing increased, and a lot of Canadians started to look for larger homes with more outdoor space as they started to adapt to working from home and spending more time at home. While the pandemic didn't cause the Canadian housing market to crash, which I thought it was going to be honest, it highlighted some of the underlying issues that could contribute to a potential crash in the future. For example, the high level of household debt and oversupply of condos. So let's talk about the opinions of experts on the Canadian housing market. A lot of experts are predicting that the Canadian housing market is going to head for a crash. In a recent report from the Bank of Canada, it warned that the high level of household debt and the oversupply of condos could lead to a potential crash in the housing market. And additionally, some experts are predicting that interest rates are going to continue to rise in the coming years, which could put a lot of households under some financial stress. So what do we do as home buyers and investors? Well, based on the data and the opinions of experts, it appears that the Canadian housing market is a lot more likely to crash than the US housing market. And this is due to a number of factors, including high household debt, an oversupply of condos, and the potential for more interest rate hikes. For home buyers and investors, it's important to take a cautious approach when entering the Canadian housing market. It's also essential to do your research and to ensure that you're not overextending yourself financially. The tip that I like to use is I like to build risk into my pro formas. And the way that I do that is, for example, if one of the risks is another potential interest rate hike, I try to do my research on what the sediment is for that potential hike, and then I build that new rate at the top end into my pro forma. That way I can still do the deal even in the event that they increase rates. And if they don't increase rates and my offer was accepted, well, that's just more cash flow. Additionally, it's also important to keep an eye on economic outlook and any potential changes in government policies and regulations. And overall, the Canadian housing market is facing some pretty significant challenges, and that's why I've shifted my focus from the Canadian market to the US market. If you found this video helpful and insightful, don't forget to hit that thumbs up and subscribe for more videos like this, and I'll see you in the next one.